Welcome to the Tim Booker channel, where wisdom is worth spreading. We wish you a pleasant listening experience. Today, we will delve into The Future of Money, which explores whether digital currency can become the dominant force in the economy in the age of rapid information technology growth on the internet. In today's world, the use of paper currency is steadily decreasing, and its substitute is digital currency. The development of digital currency has become a strong trend, encompassing both central bank-issued digital currencies, CBDCs, and privately issued digital currencies. Regarding central bank-issued digital currencies, China and Sweden are at the forefront, vigorously promoting them within their respective nations. On the other hand, private entities like Facebook, now known as Meta, and corporate giants like Amazon have taken the lead in developing digital currencies that can be used on designated platforms. Additionally, the most well-known digital currency, Bitcoin, has at one point reached a market capitalization in the trillions. However, our focus today will primarily be on central bank-issued digital currencies. In the following discussions, unless otherwise specified, when we refer to digital currency, we mean central bank-issued digital currency, CBDC, not privately issued digital currencies. Many believe that digital currency development is faster in developed countries and slower in developing ones. However, the reality is not that simple. China and Sweden, representing a developing and a developed country, respectively, have been the fastest to adopt digital currency. In contrast, leading developed nations such as the United States, Japan, and European Union countries have been relatively slow in developing central bank digital currencies. Currently, major countries are designing the pace of central bank digital currency development, considering the compatibility of the advantages of digital currency with their national circumstances, as well as taking into account some of the downsides associated with digital currencies, which we will discuss later. The author of this book, Ishwar S. Prasad, is an Indian-American renowned economist currently serving as a professor at Cornell University in the United States. He has a unique perspective on many classic economic theories and cutting-edge transformations in the field. His personal experience growing up in India and his observations of the obstacles and driving forces in developing economies provide valuable insights that he can compare with his experiences in the United States, giving readers a comprehensive understanding of economic development characteristics in both developing and developed countries. Next, I will break down this book into 3 parts. 1. The current status of central bank-issued digital currencies around the world. 2. The benefits of promoting digital currencies. 3. The drawbacks brought about by digital currencies. Let's begin by examining the development of digital currencies in various countries. In general, with the advancement of smartphones, digital currencies have gained a more substantial technological and material foundation. However, the development of digital currencies varies widely among different countries. So, is the development of digital currency determined by a country's economic strength or its technological level? You can find the answers to these questions by observing the development status of digital currencies in various nations. The fastest developing countries in terms of digital currencies are China and Sweden. In China, the central bank established a dedicated research group to study the feasibility of digital currency as early as 2014. This research group evolved into the Digital Currency Research Institute in 2017. By 2020, digital currency, also known as the electronic renminbi, was finally introduced. By the end of 2022, pilot regions for digital currency had expanded to include municipalities like Beijing, Tianjin, Shanghai, Fujian, and Shandong. Some may wonder why digital currency was only piloted in these regions at the end of the last year when trends like using WeChat and Alipay for payments had already swept the country several years earlier. The reason is that electronic payments and digital currency are two different things. WeChat and Alipay are not forms of currency themselves, they are tools for accounting and transferring funds. In other words, the balance in your WeChat or Alipay account is just a form of record keeping, while real money remains in your bank account. Central bank digital currency, on the other hand, is a legal tender with equivalent value to physical currency. The author of this book believes that the introduction of the electronic renminbi has placed China ahead of other major economies in the central bank digital currency sector. Following closely behind China is Sweden. Similar to China, before the introduction of the Swedish central bank's digital currency, the country had already widely adopted private entity-developed systems like Switch. In this system, transferring money is as simple as knowing the recipient's phone number. The founders of the switch system included several well-known private banks in the Nordic region, such as the Nordea Bank, Danske Bank, Swedbank, and the Savings Bank. It was launched in 2012 and quickly gained nationwide popularity. By 2018, 87% of Swedes were using electronic payments, with the majority using the switch system. It's important to note that this electronic payment system is similar in nature to WeChat and Alipay in China and is not the central bank digital currency we are discussing in this article. In 2016, when the switch system was rapidly gaining ground, the then deputy governor of the Swedish central bank mentioned the urgency of issuing digital currency, stating that they couldn't wait any longer. The following year, Sweden began researching the feasibility of digital currency. In 2020, almost simultaneously with China, the Swedish central bank introduced digital currency, also known as the electronic krona. Compared to other countries' digital currency introduction processes, China and Sweden were ahead of the curve. These two countries shared two commonalities. They were experiencing strong economic growth at the time, and in this context, private entities actively engaged in various technological explorations, developed electronic payment systems, and rapidly gained the majority of the market. This led the central banks to recognize the importance of entering this space and to begin research and promotion of central bank digital currencies. Interestingly, over 1,000 years ago during the Northern Song dynasty, China was the first country in the world to use paper currency, and now it is one of the first countries to nearly eliminate paper currency. Sweden, on the other hand, was the first country in Europe to use paper currency over 300 years ago and has now become one of the first European nations to significantly reduce the use of paper currency. Several other countries with fast-growing digital currencies include Venezuela, Ecuador, the Marshall Islands, Uruguay, the Bahamas, and some other developing nations. Due to space constraints, we will primarily focus on Venezuela, Ecuador, and the Marshall Islands in the following discussions. Unlike China and Sweden, whose economies were performing well at the time, the promotion of digital currencies in Venezuela and Ecuador was driven by worsening economic conditions. The governments in these countries sought to use new digital currencies to improve their economic situations. In the decade leading up to 2018, Venezuela experienced hyperinflation, with prices increasing over 100-fold, causing severe economic turmoil. To address these economic problems, the government introduced a digital currency. Venezuela, with the world's largest known oil reserves, heavily relies on its oil industry, which contributes to 90% of its national revenue. Thus, this digital currency is backed by oil and is commonly known as the petro. In 2018, during President Maduro's administration, Venezuela released a white paper stating that the petro was a crucial tool for achieving economic stability and financial independence. They also intended to use the petro for international trade settlements, replacing the use of the US dollar. However, the petro faced resistance from the United States, resulting in restrictions on international transactions. Nevertheless, within the country, the Venezuelan government continued to promote the petro. In 2019, the government required large state-owned banks to conduct transactions using the petro, and in December of that year, they distributed subsidies to citizens who registered their petro wallets on government-designated platforms. The author notes that this marked the first-ever helicopter money distribution through an official digital currency. Following this, the petro saw widespread adoption within the country. But what does the future hold for the petro? The author believes that the durability of any currency is closely tied to the government's capabilities and creditworthiness. Due to corruption within the Venezuelan government, the petro, like other previously issued national currencies, is expected to continue devaluing in the future. Using the petro to circumvent U.S. financial sanctions has also proven unsuccessful, as events later confirmed. An early sign of the petro's fate was revealed when, in 2018, the Venezuelan government announced several large oil fields as collateral for the petro, claiming they were actively being drilled. However, a daring Reuters journalist investigated one of these oil fields and found no drilling activity. Similar to Venezuela, Ecuador is another South American country that vigorously promoted electronic currency. It faced similar challenges. In the early 21st century, due to poor economic management, Ecuador's official currency, the sucre, suffered a significant devaluation, and the US dollar became the de facto currency in use. To restore confidence in the national currency, President Correa initiated a project called the Electronic Money System in 2014. A year later, the project was officially launched. Through this system, users could create accounts on their mobile phones, deposit money, and make transactions. Ecuador's push for electronic currency came earlier in time compared to the rapid development of digital currencies in China and Sweden. Initially, Ecuador's population showed great enthusiasm for this new digital currency. However, over time, due to poor economic management, people began to lose faith in the central bank, and the issuance of the digital currency was hindered. Additionally, Korea's government twice defaulted on external debt, causing distrust among domestic and international investors toward the new central bank digital currency. The author notes that the lack of trust in both the central bank and the government is a significant restraining factor. Following Korea's presidency, Moreno took office as the president of Ecuador, but he faced a similar situation. To expand the utility of the central bank's digital currency, they shifted to a public-private partnership model, as the central bank had limited success. The Marshall Islands, on the other hand, represents a unique case among countries with rapidly advancing electronic currencies due to its peculiar history and geographical factors. Historically, the country was under U.S. administration for over 40 years after World War II and only achieved independence in 1986. During and after this period, the U.S. dollar was used as the official currency because of its close relationship with the United States. The question arises, why didn't the Marshall Islands issue its own independent currency? The answer lies in its geographical circumstances. This island nation is located in the Central Pacific, with a population of less than 100,000 spread across approximately 1,200 islands. The small population and widespread distribution made it challenging and costly to issue traditional paper currency and manage it effectively. Due to the strong historical connection with the United States, using the US dollar domestically became the natural choice. The development of digital currencies provided the Marshall Islands with an opportunity to establish their sovereign currency. In 2018, the country's legislature passed a law to create their own cryptocurrency. Given the small population and limited resources, they didn't have the means to invest in developing a digital currency like China or Sweden. Instead, they chose to issue their currency using blockchain technology, which was gaining popularity. This resulted in the world's first decentralized government-issued digital currency. However, decentralized blockchain technology makes it challenging to trace transaction records, raising concerns about potential money laundering when using this digital currency. At the time, a U.S. Treasury official meeting with the Marshall Islands finance minister expressed strong opposition to the new currency, stating that he did not like it and would never support it. He believed that the country might be trying to use blockchain technology for money laundering to increase wealth. The author suggests that there might be another significant reason that the United States opposed it, which was not mentioned in the book. If the Marshall Islands experiments succeeded, it could have a negative impact on countries that centrally issue their own currencies. This may have been the primary reason for U.S. opposition. Nonetheless, the Marshall Islands did not give up. To gain international trust in their sovereign currency, they added provisions specifying that individuals or institutions using their digital currency had to undergo official screening and approval, aiming to make their digital currency system more transparent and reduce money laundering suspicions. As for the success or failure of this initiative, only time will tell. Finally, when shifting the focus from developing countries to the world's most advanced regions, such as the United States, Japan, and Europe, one would discover that electronic currencies are not as prevalent as one might imagine. These leading global economic powers have been slow to embrace digital currencies. The speed of digital currency development is not solely determined by economic and technological factors but is heavily influenced by the willingness of governments. Some countries strongly encourage digital currency development, while others are less enthusiastic about it. So, what advantages do digital currencies offer that make some countries support them, and what disadvantages hinder their progress in other nations? Next, let's explore the benefits of central bank digital currencies. First and foremost, their most significant advantage lies in making personal payments more convenient. When using cash, people need to take out their wallets, count money, receive change from merchants, and sometimes deal with the hassle of receiving small bills. With digital currency, a simple tap of two smartphones allows for instant payment, even in the absence of an internet connection. In our modern, efficiency-driven society, this saves people a considerable amount of time in their transactions. The second benefit of digital currency is its ability to eliminate counterfeit money. Throughout history and in the present day, counterfeit currency has been a persistent issue. In the 18th century, the Swedish central bank introduced numerous watermarks and embossments on banknotes to deter counterfeiters. However, people continued to employ various technologies to create counterfeit money. The U.S. government's investigations in 2006 found that for every 10,000 banknotes in circulation, one was counterfeit. While the proportion might seem small, receiving counterfeit money poses a significant problem for individuals. Digital currency issued by central banks, however, reduces the opportunity for counterfeit money to enter circulation. Another advantage is that creating physical currency consumes substantial natural resources, whereas digital currency can conserve these resources, making it the third benefit of digital currencies. Throughout the history of money development, precious metals and paper currency have been the two most important forms of currency over the past 2 millennia. Precious metals inevitably experience wear and resource loss during transactions. Although paper currency greatly improved this situation, manufacturing it still requires a significant amount of resources. For instance, in the United States, in 2020, the cost of printing banknotes amounted to $877 million out of a total face value of $146 billion, representing a high proportion of 0.6%. By using electronic currency, these funds could be saved and utilized to enhance the living standards of the lower strata of society, fostering social equity. Beyond the production process, paper currency necessitates protection during transportation and storage, consuming national resources to guard against robberies and theft. Digital currency development eliminates the need for substantial human and physical resources. Furthermore, the fourth benefit of digital currency is the convenience it offers in distributing funds to the general population. In theory, with widespread digital currency adoption, each citizen would need to create an account, and the government could instantly transfer funds to every individual's account, implementing a form of helicopter money, which improves the conditions of societies less fortunate. During economic crises that require stimulating consumer spending for relief, the widespread adoption of digital currency can help nations quickly achieve this goal by distributing funds directly to people's accounts, thereby alleviating economic crises. The fifth advantage of digital currency is its potential to reduce corruption. Corruption is a more serious problem in developing countries compared to developed nations. The author, an Indian American who grew up in India before studying in the United States, provides an example of police officers collecting additional fees when verifying passport identities. This practice is not unique to the author but is a societal phenomenon in India. Settling transactions using digital currency leaves traces on the internet, which can reduce the occurrence of such corruption. It also allows for the detection of various underground transactions. The final benefit of digital currency is its potential to reduce the spread of viruses. In times when paper currency was prevalent, there was a joke about the dirtiest thing in the world that everyone adores. What is it? Money. Paper currency, from production to retirement, might pass through countless hands in various unsanitary environments. As a result, it carries a multitude of bacteria and microorganisms. According to a study by a New York University team, the average surface of a US dollar bill is contaminated with about 3,000 types of bacteria. In the case of dangerous or highly infectious pathogens, this could pose more significant societal risks. During the early stages of the COVID-19 pandemic in China in early 2020, concerns emerged about the virus's presence on cash. The central bank temporarily halted the inter-province transportation of paper currency. Once these banknotes were recovered, they underwent ultraviolet and high-temperature disinfection processes and were stored for 14 days, corresponding to the estimated incubation period of the virus. Only after these measures could the banknotes re-enter circulation. Similar practices were later adopted by the U.S. Federal Reserve to disinfect U.S. dollar bills returning from Asian countries. If digital currency were used, these health concerns would be largely eliminated. Given all these advantages of digital currency, it's easy to understand why it's rapidly advancing in some countries. However, in countries like the United States, Japan, and most of Europe except for the Nordic countries, where there is greater economic strength and higher technological proficiency, digital currencies have been slow to gain traction. Why are digital currencies progressing slowly? Primarily, it's because there are concerns about some downsides of digital currencies, and suitable solutions have not yet been developed. The author believes that the most significant problem with digital currencies is the potential for privacy breaches. In today's world, with an increasing level of civilization, people value their privacy more than ever. When using digital currency for transactions, every large or small purchase leaves a trace in the system. The Swedish central bank once issued an important statement, indicating that all transactions using electronic kronor are traceable. This makes some people concerned about digital currencies. They believe that it could reveal not only a person's spending habits but also their income level, movements, and even characteristics and psychological traits. Concerns about revealing trade secrets and affecting a company's development have led to the collective resistance of digital currencies in many regions. The European Central Bank conducted a survey in the Eurozone and found that people in the Eurozone highly value their privacy and are unwilling to use digital currencies to the extent that they'd overlook the convenience they offer. Currently, the digital renminbi issued by the People's Bank of China uses controllable anonymity to protect users' privacy. Further details on this were explained in our book, Digital Economy in Digital Currency. Another downside of digital currency, as mentioned in the book, is that it can encourage impulsive spending. When people have physical cash in hand, they tend to think more about whether they really need to make a purchase. With digital currency, which is intangible, a simple tap can result in money being spent, making impulsive buying more likely. The author also raises a hidden concern in the development of digital currency, which is the suppression of innovation. After central banks introduce digital currencies backed by national credit, these currencies remain effective as long as the country exists. In contrast, other privately developed currencies lack such strong credit support, and their bankruptcy or losses can affect the value of their digital currencies. The author's concern is that after central banks introduce digital currencies, people may overwhelmingly use the digital currency payment systems developed by central banks and abandon private enterprise payment systems. This would give banks an overwhelmingly competitive advantage, relieving them of the pressure to innovate. However, this concern has not materialized so far, as evidenced by the market share of the People's Bank of China's digital currency payment system, which is still not on par with WeChat and Alipay. The same goes for the digital currency payment system of the Swedish central bank, which cannot compete with the market share of Swiss. Over the years, payment habits cultivated by private companies have proven to be robust and difficult to change, emphasizing the positive aspects of market competition. For instance, in China, banks previously favored lending to large state-owned enterprises, making it relatively difficult for small and micro-enterprises and individuals to obtain loans. Financial services provided by Alibaba's Alipay and Tencent's WeChat filled this gap to a large extent. If a country continues to prioritize the interests of private enterprises while developing central bank digital currencies, collaboration between banks and businesses can create a better financial environment for consumers. In summary, the book's key points have been shared. In the first part, I introduced the development of digital currencies in various countries. China and Sweden are leading the way, with the most significant success. Venezuela and Ecuador, while promoting digital currencies aggressively, have had less success. Venezuela introduced a digital currency called Petro, backed by its natural resources, but due to government economic mismanagement, it gradually lost people's trust and was essentially abandoned. Ecuador's digital currency, backed by the government's credit, also failed due to the country's poor economic situation, causing a loss of trust. The Republic of the Marshall Islands presents a unique case. Because of its dispersed population, it never had a central bank or its own sovereign currency, so it sought to develop a sovereign currency following the trend of Bitcoin. Facing resistance from the international community, they tried to adopt more regulations to comply with international standards for their digital currency. However, some developed countries and regions, such as the United States, Japan, and Europe, have shown less support for digital currencies. In the second part, I discussed the benefits brought by digital currencies. They make payments more convenient, life easier, reduce corruption, and minimize resource waste associated with the production and transport of physical currencies. Additionally, digital currencies can reduce the adverse effects of viruses carried on physical currencies like paper money. In the third part, I talked about people's concerns regarding central bank digital currency adoption, such as the fear of stifling innovation in private enterprise payment systems, encouraging impulsive spending, and exposing personal consumption privacy. Overall, these concerns can be addressed or mitigated through various technical solutions. Over thousands of years, human society has transitioned from agricultural to industrial, and now to an information society with an explosion of information. Money is constantly transforming, and digital currency is essentially a form of information that can measure the value of other information, physical goods. A thorough understanding of its advantages and disadvantages is essential to make the best use of it in an information-driven era, seeking ways to better serve human development. In addition to these topics, the book also explores issues such as legal protections for cash usage, the impact of digital currencies on the international payment system, and the technological principles behind Bitcoin. Interested readers are welcome to click on the e-book at the end of the manuscript for further reading. That's all for today, and congratulations for finishing another book. We appreciate your support and attention. Please subscribe to the Tim Booker Channel audiobook channel. Give it a thumbs up and share it with your family and friends. Wisdom is worth spreading, and let's open the door to a brighter future. Thank you and goodbye.